Hi everyone.
Good afternoon, everyone. Welcome.
Everyone's muted. Cool.
Yeah, that's better.
We can hear you now.
Oh, okay, put it on mute.
Yeah.
How are you, Damon?
Good, yourselves.
Awesome. We'll be starting in probably a minute or two. Just waiting for a few more people to jump on.
Hey, are you in the warehouse?
Yeah, in the warehouse.
Yeah.
We'll give it one more minute, just for the last people to jump on. Maybe more. Cool.
Right, should
All
we
right.
start?
Yeah, definitely. I'll just share the presentation for today. Just loading now. Awesome. All right.
So welcome everyone to webinar number 10, in which we're going to really go through what we've covered in the previous 9 webinars and just really recap on everything. And we're going to take questions and answers at the end as well. So make a note of any questions you have, and we'll endeavour to answer them at the end.
Yep, perfect.
So my name's Carl Burling. I'm one of the founders of the fund, and Jack's the other founder.
Yeah.
We founded the fund 5 years ago with one single property and 7 investors, and now today we have 138 investors and 13 properties with a value of over 100 million. So our aim has always been to buy value add properties. So properties that we can add value to within the short to medium term. So properties that are under rented or have short-term leases or have opportunities to expand the footprint for the rentable area. We only focus on industrial, and we'll talk about that in the next couple of slides. And our overall aim is to provide our investors with long-term competitive income and capital gains.
So this is just recapping what we've covered in the last 9 webinars that we've done. So it's a series of webinars taking you through what to look for in terms of what type of property, the management of it, creating value from it, financing it, and then we've put real life examples on the case studies as well. So that's what we've covered in the last 9 weeks. So this is a summary of it. So the first webinar we covered was why invest in industrial property, which we prefer industrial property over the other types of different property classes and commercial property. Those are residential property and office and retail properties. So industrial's always outperformed the other classes in the past 7 years. Better returns, better capital growth, and in the current market, much lower vacancy than the rest of the other classes, which is why one of the predominantly reasons why we prefer industrial property over the other 3 classes. So here's
So this graph or presentation from Morgan Stanley clearly shows that industrial property is the best performer of all the commercial property classes, and that's been over the last 15 years. So the blue graph is industrial property, and you can see that over a period of 1 year, 3 years, 5 years, 10 years, and 15 years, industrial property has always outperformed all the other classes, and that's a significant trend, and that's one of the main reasons why we're focusing on industrial.
Webinar number 2 was our due diligence process. So all of these webinars are on our website as well. So if anyone wants to rewatch and cover them off, we've got them there. So webinar number 2 was our due diligence process. So we covered 5 key points to look for when we're buying an industrial property.
And it's really important to say here that when we're buying a property for the fund, we've got a 37-point check.
Yep.
So it's a really thorough due diligence process, and we just, to cover 37 would take too long, but these are the key points.
Yeah, so the key ones we've got is the lease. That's probably the biggest point. There's a lot of factors in that lease, and there's a whole session we do on the lease actually in one of the webinars, and it's looking at those key points, the key terms in the lease, and those additional clauses, because a lot of those additional clauses can really either be detrimental to the value of the property or add a substantial amount of value depending on how you structure those clauses and what clauses you've added or chosen to leave out or deleted. So they can make a huge difference. So we cover a whole session on that, and that's the first point that we look at when we're looking at a potential property. The second one is the building area survey. So we've got an example of that in a minute, and that's making sure you're covering the right area. So when you're buying the property, you're checking what area building you're purchasing versus what's actually in the leasable area and what's included in the leases. Because often you'll find there's certain areas that haven't been included that you're actually buying. So it's within your property, but has not been included or rentalized in the leases. So that's an easy way to add a lot of value. The earthquake and structural. So the earthquake and structural engineering or design of the building, if you like, that's very important because you've got to make sure you're meeting the criteria that the banks and insurance require.
And as we showed in the previous webinar, that a building that's earthquake challenged isn't necessarily a bad thing.
Yeah.
If you can fix it up cheaply.
Yeah.
Quite often people will see a building with a low earthquake rating and they'll basically not proceed. So yeah, so often an earthquake challenge building is a good opportunity.
Yeah, we've done that on a few of our ones in the fund as well, which has been great. And also the council file and the LIM. So that's another major point that we check. What consents are there on the council file and what is documented on the LIM. So that holds all the information that council has on the particular property. So that's a major one because you want to make sure all those building consents have been signed off, or see what building consents haven't been signed off, because that can be very detrimental to the property. And then the location. That's probably the fifth point. The fifth major point we look at is the location. So is it in a growth area? What's the surrounding properties like? Is there a low vacancy? And what's the square meter rate based on that location? So that's a major one and to really consider and do a lot of due diligence in. So this was one example of a building area survey. So this is Carbine Road, one of the properties that we bought. We ran this as an example last week. However, just an example, this building area here, this yard in the center here, when we bought the building, we knew we were buying all this area that's outlined in red. However, this yard here in the center of the building wasn't rentalized in any of the leases. So we knew that once the tenant that we had in the middle warehouse, their lease was ending about a year after we purchased it. And we managed to get another tenant in there once they left, a much better tenant, but we were able to rentalize that entire yard area. So that was a huge uplift in rental that we had on this property just by checking the building area versus what's actually been included in the lease.
And we also found a locked up garage,
Yeah.
which the valuer hadn't seen. And it was basically a quite a large garage that hadn't been rentalized.
Yeah. So all of that added extra square meters to the area that we could actually include in the lease, which uplifts the amount of lease that the tenant's charging, which in turn creates better cash flow for the investors and in turn adds value to the fund. Oh, sorry. Webinar number 3 was the ownership options for commercial property investment. So these are the different structures.
Yeah, so we covered 4 structures. There's direct ownership of a property. You can own it outright or with a friend or a family member. There's unlisted syndicates, which quite often are limited to 1 or 2 or 3 properties, and pretty much you're locked into that syndicate to quite the 1 or 2, 3 properties, and it's the same shareholders normally stay throughout the lifetime of the syndicate. So we actually started Provincia with a small syndicate. It was seven investors in 1 property. So, but since then we've expanded it to 13 properties and 138 investors. So another option is listed property fund. So you can see those on the NZX. They can either be a trust or a company, and there's a number of them on the NZX. So that's another way to own or shares in industrial property or commercial property. And last but not least is the unlisted fund. So that's what Provincia is. So we're an unlisted property fund, and the format of our company is a limited liability company. So just a quick summary on our structure, on Provincia structure. The way we came up with this is it was the most simple structure and it was easy to understand. So we've got in the middle here, we've got the fund, which is company, and the company directly owns all the properties and receives rent from those properties. The shareholders own shares in the company and receive dividends. The bank over here, which is currently ASB, provides the debt and we pay interest, and the management company over here charges fees and provides the management services fee. Up the top left here is the board of directors. So they're elected by the shareholders and they govern the running of the fund. So pretty simple structure, and it's it's a limited liability with shareholders, and the fund owns all properties.
So webinar number 4, this is the one where we took you through the leases. So that was understanding the commercial leases. So going through all the different clauses that can add substantial amount of value to the fund if you get them right. So this was taking it through an agreement versus what a deed of lease is. So the agreement to lease, which is the initial document that you negotiate on, versus the deed, which sets out all the rules. Then we went on to the outgoings. So making sure we're including all of the outgoings in the fund, and the make good clause. So what obligations a tenant has when they leave the building, and basically making good the premises that they had been in for the duration of the lease. And then the guarantees, so the different type of guarantees, that's a personal guarantee versus no guarantee versus a personal guarantee, or a bank bond or a cash bond. So we took you through those definitions, and really what's really good is to make sure you've got those kind of guarantees. The best ones are the bank bonds or cash bonds. You generate 12 months and 24 months if you can get them, because that's the maximum amount of security you can get. And then every other clause that matters, that how we affect value, how it affects the value. So we use some examples that we add into Schedule 3. Schedule 3 is the last schedule on the agreement or deed of lease. So that's when anyone or any person or any company can agree to add additional clauses, and all of those clauses can have major impacts on the value. So we took you through a few examples of that. Webinar number 5, that was the cap rates and valuation. So that was explaining how the capitalization rates work and how the valuers assess the property and the valuation methodology that they apply when carrying out a valuation on a commercial property.
And it's really, really important if you're getting into commercial property to understand valuations. And if you can get hold of a valuation or 2 or 3, read them and study them. That's the best way to understand how the valuers work and how they calculate the end value and the square meter rates and everything. So it's really important to understand it. And it's really important to be able to add value and understand how commercial property works. So really, there's only two ways. So to add value. So you can buy a property that's under rented and increase the rent, or you can decrease the cap rate, and you can do that by improving the terms of the lease. You can make improvements to the building, make it more appealing. You can add, you can also get a better quality tenant. So someone, a tenant that's going to be really reliable paying the rent, and has a good name and reputation. So yeah, so those are the two ways you can really add value: is decrease the cap rate or increase the rent. And this equation, which we talked about, is really important to understand. So as you can see, if you increase the rent, the value side of the equation improves, and if you decrease the cap rate, you can also improve the value. So it's really important. Get a couple of books out, read about commercial valuation if you're looking at getting into it.
This is the first formula that we use when we're just initially looking at a property to gauge an idea on what the value would be based on the cap rates in the surrounding market. So this is just a quick, easy way to get a feel if you're on the right path. So that's the first thing we look at.
Yeah. So, and if you can do both, if you can increase the rent and decrease the cap rate at the same time, you're doing really well.
Yeah. Webinar number 6, that was that we had a guest speaker involved in that. So that was Chris Krishna from Mortgage Suite. So he came in and talked about the financing of industrial property or commercial property in general. So that's getting financing to buy commercial property. So the main criteria that he mentioned was you can get usually up to 65% LVR, so loan to value ratio. So the banks will lend 65%, generally speaking, against the industrial property or commercial property that you're buying, provided there is the lease meets the criteria, and also the IEP, so that initial earthquake procedure that we touched on is above the standard requirement of 67%. So generally speaking, they'll go up to 65% on that loan to value ratio. They'll look at the quality of the lease. So make sure that lease isn't ending very soon. So some leases we've seen has 4 months to run. The banks will question that and what the tenant's intent are. Also cash flow. So a huge important part of it right now is the serviceability. So that's the assessment that the banks do based on certain test rates and assessing the cash flow to make sure it's got enough interest cover. And the last one was using other securities. So what other options do you have? Can you borrow against your own residential portfolio if you've got residential? And then what's the structure on those particular residential properties or other commercial properties that you had? So we went into a bit of detail on that. And overall, it was a good, really good session explaining how to be able to gain finance to purchase commercial property.
Yeah, and as Jack said, that all the webinars are on the website.
Yeah.
So just jump on there if you want to recap.
So webinar number 7, this was an example of what we do with our fund quite a bit, and it's quite common in the current market, and that's sale and leasebacks. So sale and leasebacks are when a owner owns the site and the business, and it's quite common in the common market that those owners that own the building and the business that's in the building are actually generally writing leasebacks to themselves, but selling the building generally to free up capital so that they can invest that capital to expand the business rather than getting finance to expand the business, which has been a common trend on the back of COVID. There's quite a lot of sale and leasebacks that we're seeing, which we do within the fund. So this is one example of a sale and leaseback. This is the property that we had at 73 Corbett Road, which is in New Plymouth. It was the latest purchase for our fund. So it was a really good example. It was a really good sale and leaseback that we actually achieved. So the tenant, which is a Superior Stainless, really good company, they basically do the servicing for the oil and gas industry in New Plymouth and throughout New Zealand, and the dairy industry, and also the stock feed. So it's diversified over multiple industries, specializing in the steel side of it. This is their only premises that they've got, and they took a 10-year lease back on the building. So that's a 10-year triple, and it was a triple net lease. So a triple net lease means the tenants pay the rent, they pay the outgoings, but they also pay the capital expenditure. So the capex, so the capital expenditure that has to be on the building, the tenants actually pay it. So basically the tenants will maintain and look after this property for a period of 10 years. So it's a really strong lease that we're able to negotiate on this building, especially given it was a sale and leaseback.
And the big win for the tenant who was the owner is that he gets to recapitalize his business. So he gets a lump sum of money which he's investing in his business, and so it's a win-win for both us and the tenant.
And the building itself is really good too. You can see here it's actually got 3 gantries in. It's got 2 5-ton gantries which are on the left there, and then it's got a big 10-ton gantry. It's at the other end of, not in this picture. There's a 5-ton there, and there's a 10-ton gantry in the building as well. So we've got the gantries as well, which is really good.
This is what we call one of our workhorse properties. Most of them are. We don't really like trophy buildings.
No. We always want something we can add value to, either at the beginning of the lease. In this case, it was negotiating that triple net lease with the tenant that really gave us that uplift in value from day one, and really good favorable rent review terms that we built into this lease. Plus, it's got limited capital expenditure, well, no capital expenditure, because it's a 10-year triple net lease. So we look at buildings that we can either add the value on day one or have medium to short-term upside. So that might mean there's a lease ending in 2 years' time, but we know the building is massively under rented, which is another example that we've done within our property fund. So these are the sale and leasebacks, we just covered them. So all clauses are important in the deed of lease, especially when you're considering to sell and leaseback, to see what clauses that vendor of the particular property wants to include. You're able to design your own lease. So that's a big one. You've got that bargaining power that you're actually negotiating with the vendor, but also the tenant at the same time. So you've got a lot more bargaining power when it comes to a sale and leaseback. So you're actually got the ability to try and dictate those lease terms. In this case, that's how we were able to get that 10-year triple net lease, which added substantial value to this building. As Carl touched on, it's a win-win for the vendor and the tenant. They can recapitalize in the business, they get the money, and they know they've got control, especially in this site, because it's triple net, they've got control over that building for the 10 years. And it's, like I said, it's add value before you buy. So that's a major one. We're locking that upside in because of that triple net lease, or you could do it with other certain clauses that you include because it's a sale and lease back. And there's good opportunities in the current economic climate, especially on the back of COVID and the impacts COVID had, and with rising interest rates. A lot of businesses are looking at releasing those buildings so that they can get more capital to reinvest in the business. So webinar number 8, that was on property management. So that was maximizing your returns via really good management to make sure you're maximizing the rent you can get and passing on maximum operating expenses on charge to the tenants.
And it's so important to get this right in terms of recovering operating expenses and getting all the accounting side of it and collection of the rent, the OPEX, and organising capital expenditure. So so the main aim of property management is, number 1 is collect the rent. Number 2 is to collect all the operating expenses and pass the maximum amount on to the tenant.
Yep. And organising CapEx, that's a huge one. So making sure you've got competitive quotes, multiple quotes, and making sure you're doing right CapEx at the right time for the asset. Rent reviews, making sure you don't miss a rent review and really maximising those rent reviews so that you're adding the best possible returns for the individual investor. And also those lease renewals, making sure you're either doing them early and giving them sufficient notice, even doing early rent renewals and early renewals to add value. And then also the repairs and maintenance. So making sure you keep track of any repairs and maintenance to the buildings, and making sure you can on charge, as Carl's just touched on, making sure you can on charge as much as you can of those repairs and maintenance as OPEX, as an expense to the tenant. And then webinar number 9. So that was last week's webinar. We talked about a real life case study that one of the properties that we bought for Provincia Property Fund, which was Carbine Road in Mount Wellington. So that was this example with the area of yard that we were able to rentalize. There was also a lot of other really good points for this property. We bought it with a low IEP.
Yeah.
So, yeah.
So the main point there is it was an earthquake challenge building, so we got it way cheaper than what you'd normally pay for that building in that position.
Yeah.
Prime position in Penrose, right next to where the Tip Top ice cream factory is. So really good land, really good position, and we managed to get it cheap because everyone walked away because it was earthquake challenged, or supposedly very earthquake challenged.
But it was really easy to remedy. One building we actually got our engineer to assess, and it already had steel in the walls. So that basically, that was just their report cost to do. And the other building, just this is the example here, just needed cross bracing in the roof, where you can see these red lines are, and a steel lintel put in the wall where the previous tenant had actually cut through the wall to create two adjoining spaces. So we just had to add that steel lintel and those cross bracing, which isn't actually major work, to bring the building up to it was above 70 or 80% actually, just by doing this. So it wasn't a major amount of work versus what people would put off purchasing the building from. And also there was major upsides in those leases. So the much of the property was actually very much under rented. And we noticed that we could actually create more value from those areas that weren't actually rentalized in the existing lease. So this property really had it all.
Yeah, so really, as we've discussed, our strategy, or Provincia's strategy, is to focus only on industrial for the reasons we've talked about, being the best performer in the commercial market, and also that value add, which was spoken in the last example. So also focusing on areas with sound economics, so areas that have other industry, areas that are growing, have population growth, and good businesses. So, and also our other focus is on the properties that are valued between 5 and 10 million. And the reason for that is if you get a property that's 20 or 30 or 40 million dollars and it's got a single tenant, but that tenant never leaves, it's a big hole to fill. And so we like to think we're very good with our occupancy, which is really important to maintain the rent and the cash flow for the fund. And Jack here's got a pretty good track record with his management team.
Yeah.
Since we started the fund, we've had what is it, 102%?
102.
occupancy.
Yeah, but I'm overlapping. But just
So,
making sure we minimize those vacancy
Yeah,
areas.
so really key having those properties valued between 5 and 10 million.
Yep.
So they're easy to find tenants for, and you get less vacancy loss between tenants.
Yeah, absolutely.
So a little bit about our track record, and a lot of this is attributed to our value add strategy, where we're getting constant capital gains, and we also have a very consistent dividend payment. So over the 4 years, 2019 to 2022, we've got an average total return of just over 15%. So what that means is that that's the 15% total return is a sum of our dividend and also the gain in the share price. So and it's important to have both, otherwise you don't keep up with inflation. So you don't want the value of your share to erode with time. And the way we do that is we're always buying properties that we can add value to. So the share price is increasing over time. So
even just this year, the past financial year that's just been, we've had properties number 2 and 3 that we were both had purchased. So properties that were bought in 2018 and 2019 in the fund, we've just been able to renegotiate and really uplift, extract quite a lot of value from them. So that shows over time the properties we're buying, we're analysing those sites and really trying to extract maximum value throughout holding those assets, which we've done throughout owning the different properties in the fund.
Yeah. So as I've just discussed, we started off at $1 in November 2017. So now, and the share price at March 2022 was $1.56. So and every year we have a revaluation, and it's the value is based purely on the value of the properties, less all the liabilities. So it's pretty transparent, and through that we're able to value the value of each person's share. So we're open for investment now. So we've got a discounted share offer of $1.51, and that's open until the 31 March 2023. After that point, we'll issue a new investment statement, and we're pretty confident that the share price will be going up, aren't we, Jack?
Yeah, we're just getting the portfolio revalued at the moment, so the valuers are all going through all the buildings as we speak, and feedback's been really positive so far. There's been uplift in terms of value, especially because of the work that we've done over the past financial year, and also the market rates. The market rental square meter rates have really gone up. You'll see an industrial property at the moment, so that's really helped us a lot. So it's looking really positive, and there likely will be uplift in the share price as of March 31st for the next financial year, which is great.
So if you can investing, call either Jack or me, or go through our website, and you can apply there. So it's just a shot of some of our typical tenants doing their work. This is an engine rebuilder. So we've got, basic engineering businesses, lifeblood of the country's economy. So they're the type of tenants that we like. And
all right, I'll open this up to some Q&As now. So I'll just stop sharing this slide. So that basically is a summary of what we've done in the last 9 webinars. This is webinar 10. So that's a summary of what we've taken everyone through the last 9 weeks. And so if there's any questions on either the fund itself today, what we're doing with the property fund, or what we've done in the last 9 weeks, any questions on any of that, feel free to either unmute your mics and ask direct, or type into the chat bar, and we can answer it. We've just got one here now, which is, I see Provincia is using ASB. Any comments, Ari, using one main bank for funding rather than using several banks to spread risk?
yeah, so we have used ASB exclusively up until now. We're at the point with ASB where they're comfortable with our debt level. So we will be looking at other banks in the new financial year.
Yep.
So yep, that's a really good question, Jeremy. Thanks. And yeah, we'll be definitely looking at another bank in the new year.
And ASB has been really supportive of us since we set up, and it had offered us really, really good competitive financing rates in terms of the margin, as opposed to other banks as well. So we are looking at other banks, as Carl's mentioned, but still the financing rates that we've been getting from ASB have been quite superior.
So question from Mark. So have we got plans for 2, 5 year, 10 years an IPO? I think you probably mean a listing. So that's something that we may consider, but realistically, to make it economical, we would have to be about twice the size, so around the 200 million mark, to even consider listing. And if we did, it would have to be approved by the shareholders, because it would be a major change in direction for the company. And but that is something that we will consider once the fund is of an economical size to do it.
And I think for the next 2, 5 and 10 years, the plan is to keep buying value add properties, and always analysing to make sure that when we purchase a property, the property that we're buying has upside in terms of value and upside in terms of cash flow. So as long as it's positive to the cents per share, so it raises the cents per share, it raises the return to investors in the fund, and it's got some kind of a twist or some kind of add value that we can really extract in the medium to short term. That's what we look for, and that's what we're going to continue doing. Here's another question. So Syndex is great for liquidity for existing investors, but I see it slightly lower price share transactions are taking place. Do you think this will impact future capital raises?
That's a really good question. So Syndex is something that we've always promised our shareholders, and it's a great form of liquidity. We thought about it long and hard, and we don't see it affecting capital raises in the future. At the moment, there's transactions going on, and it's between it's peer-to-peer, so we don't control it. But there's, in terms of shares changing hands, the transactions aren't big, and because we're not publicly listed, it won't determine the overall share price. So the share price of the share that you own is determined by the value of the properties in the fund. So does that answer your question, Mark?
Yep. Another question here: as prices of houses are going down, do you expect the same trend down with industrial properties? That's a really good question. So with so cap rates so based on these valuations that we're getting done now, cap rates have gone up. So essentially, by cap rates going up, valuations go down. That's generally speaking the trend. But what we're seeing with our properties in our particular fund, because we've been able to renegotiate those leases and we've had substantial uplift because of the market rent, we've actually got an uplift in value. So in our fund, the market rent and the rent that we're now receiving from our existing portfolio has increased substantially. That a lower cap rate, so the value is, sorry, a higher cap rate that the value is applying is still, even though that's detrimental, it's actually positive impact. So it's actually added value to our existing fund. So that's our case with our existing property. But in generally speaking, cap rates for industrial properties have moved backwards. A lot of properties are transaction at slightly lower prices than they were last.
Yeah, so what Jack's saying is that the yields have increased.
Yeah.
So that has decreased some of the values of the properties. But what we've done to offset it is we're able to put our rents up. So our properties or portfolios have basically offset that perceived or that higher yield or cap rate with an increase in rental.
Another question here: any comments about the level of insurance cover for extreme weather and events of natural disaster to cover income, cash flow, and rebuild? And do you use several different insurers to spread the risk?
Yeah, so that's a good question, Jeremy. We did have what was it, 2 claims or something, Jack?
Oh yeah, 2 small claims. It was so basically with the portfolio we only had 4 instances, 2 of which we didn't need to claim for because it was just some water overflowed down the gutters and ran down the internal warehouses, which didn't flood. They swept it out basically. And then in 2 instances the waters overflowed and ran down the internal wall of the office area. So those ones we did need to claim for because there was a bit of damage to the office, but nothing major. So we were lucky in that regard.
And we have just recently reviewed all our insurance cover with insurance valuations and replacement costs and also our cover for loss of rent. And some parts of it we've increased. And so we're very confident that we're covered for any future disasters or weather.
Yeah, so we've got 24 months loss of rent across the portfolio. So there's 24 months loss of rent for income, cash flow, and rebuild costs as well. And we've got them all renewed up to today, which they're all effective as of 31st of March. So brand new, bar 1 property. All 12 of them are being renewed as of 31st of March, as Carl just mentioned. And we go through an insurance broker who puts every offer out to different providers. So we're maximizing the best return and deal that we can get on our insurance, as well as making sure we maximize that cover and for all our investors. So really good.
I've got a question.
Yep.
The interest return is dropped a bit because I believe the interest rates have gone up. Is there, and obviously the share price is going up, which is good. So overall, it's looking pretty good. Is there going to be doing anything to improve the cash flow return, or just leaving it as is and just
So,
in
so
that?
we'll be doing quite a bit, Damon, and that's a really good question. So when in the new year, we'll be addressing it firstly by fixing the interest rates at a much lower level. So by buying forward cover, and secondly by increasing rentals. So Jack, you're gonna
Yeah. So that's the other thing. So the major one is to do those interest rate cover and those full cover swaps to get that rate down. But the other way is to really to help is to offset is to increase rentals. So we've seen dramatic increases over the last year with our portfolio. As I mentioned, that's why our values have actually gone up, and that trend is continuing to happen. So we've got some major properties whereby there's still actually substantially under rented. So in the next financial year, we've got properties and leases that are being renewed throughout the year, and they're going to have a substantial jump. So that jump in rental will be passed on to all of our investors, which is going to help that return as well.
Brilliant. Yeah, thought you'd have something in the in the baskets already.
So another question from Predrag. So his question is: floating and fixed interest rates are near 8%. Would it be better to buy properties with equity only? So I think the question means that are we going to reduce our debt? And the answer to that is slowly over time. We're currently at 40% LVR, so loan to value ratio, and the bank is likely to lend us slightly less on our next properties. So we're naturally reducing our debt over time.
And also, rather than buying with full equity, we are going to have some of those fixed covers or forward swaps in place, and that's really going to help that return as well, which makes it beneficial to buy using debt as opposed to full equity, even in this market.
What's a question from Pratik? What's the minimum investment for the fund? So the minimum investment is 50,000. So and for that you have to qualify also as a wholesale investor. So and then that's part of the application form to see if you qualify.
And we can help you with that as well if you need a hand with the application form. Just feel free to reach out to one of us. Awesome.
So any more questions? So I think we'll finish up there. Thank you all very much for sitting in with our webinars over the last 10 weeks. So Jack and I are working on a new lot of webinars, and hopefully get those started in a month or so. And we'll send you all an invite. But thank you very much for attending, and I hope you all learned a bit about the fund and a bit about investing in commercial property.
Yeah, thank you. And if anyone's got any further questions or wants to ask us anything offline, feel free to either drop us an email or give us a call. Our numbers on the internet and our emails there too. So thank you everyone.
Okay,
Cheers.
thank you. Good
Thanks,
afternoon.
Carl and Jack.
Thanks.
Bye.